Welcome to Climate News Weekly. I'm here with Julio Friedmann. Julio, good to see you.
Pleasure as always.
I think we'll get started with an interesting announcement from Exxon-Mobil projecting flat demand for oil through 2050.
So it's been a busy couple of weeks, and an awful lot has happened. One of the bigger stories that people may have missed or may have forgotten already was a pronouncement from Exxon-Mobil, and their leadership said it looks like for the foreseeable future, global oil demand will be flat. In some ways, that's a good news story because until this point, it's been growing. The fact that it's not growing is better than growing in terms of climate. And mostly that's because of a flattening of demand in China. But it is also the case that what they're saying is, look, there's a long tail. It looks like there's going to continue to be oil use for a very long time, and that demand is not going to shrink quickly. And they specifically warn of a price shock because the argument is we are underinvesting in maintaining production, and if we do, then the demand will be larger than supply. Will have price run-ups. To be fair to ExxonMobil, this has happened before. They have made these kinds of calls, and they have been correct. At some point, that will no longer be true. At some point, there will be a drop in demand, and we will no longer need to invest in oil and gas. So the real question around this kind of a story is this that moment? And Exxon makes a pretty compelling case that no, it's not. We actually need to keep producing, or else we're going to hit real price shocks and challenges.
Let me ask you something about the flat projected demand for oil, Julio. I mean, how closely should this be connected to a decline in demand, or how should we process that?
The specific forecast that ExxonMobil has made is that it will be flat through 2050. So they do not see a profound drop in demand associated with this. They have accepted that we are not growing, and to be clear, they could be wrong. There could be more dramatic drop in demand. But this has always been the challenge. This is not like the war on drugs. It's like you have a strong supply and a strong demand both. And if the supply goes down, you get price shocks. You don't get less demand. Like, that's not what happens. And to destroy demand, you need to roll out a whole bunch of things like EVs. We've seen that those are having bigger challenges than people thought. They're everything from European policy around imports to U.S. tariffs on Chinese stuff to factories and other parts of the world stalling, like to Ford slowing down, Volvo rolling back its commitments, like all these other things we're seeing. So in fact, it holds together as a story that demand is not decreasing rapidly.
What were their projections previous to this latest projection? Is this a revision?
It's not a major revision. They had incremental growth mostly in Asia, specifically in China, and to a lesser extent in India and Southeast Asia. And what they've said is it looks like that growth in demand is flattening.
Got it. So I want to transition to another story, which was reported in the Financial Times, about how coal has generated less than half of Australia's electricity for the first time through this past week. So this is a major shift in energy on the energy production side of things in Australia. How significant is this?
Right. So it's a nice compliment to the Exxon story because even though globally coal demand is growing or flat or something like that, you are seeing geographies where coal demand is dropping precipitously still. And there's two stories in the Financial Times. One of them is about Australia. Australia is noteworthy because it produces so much coal. It is very much a coal-producing nation and using nation, and costs are low and so forth. It was the case not that long ago where a very large fraction of Australia's power was produced from coal firing. Now it's down to half. Part of that is the profound and rapid growth of renewables in that part of the world. And that's been a real success story in Australia. They have great resources, in particular solar. And so they've been making very good advantage of that. The other story that's even more profound in some ways is in the United Kingdom. 140 years ago, the UK built its first coal-fired power plant. And this month, they are shutting their last. That is the Ratcliffe-on-Soar power station. And it is Britain's last coal-fired power plant. And it's already idled, basically, and will shut down formally at the end of the month. So that is a proof of the energy transition made real. And they've been able to do that in large part because of natural gas, in large part also because of offshore wind, which has been a real winner in the UK. But that took 60 years. It took 60 years to go from 100% coal to 0% coal. And we don't have that kind of time.
So, what's the difference? I know this is a tiny tangent, but what is the difference between Britain's approach to offshore wind and the US's approach, which has resulted in such a different, it's a seemingly different trajectory in terms of expansion of that resource?
There's a couple of different reasons for that. Part of it, it was just the infrastructure in the UK, the interconnects, the distance to offshore wind resources and stuff. That was easier to do. Second, it was a coherent policy story in the United Kingdom.
Hmm.
The United Kingdom's fairly small geographically. They don't have solar. They don't have a lot of other kinds of resources, whether they're geothermal or anything else. So they had a very straightforward path for decarbonization. And they said, look, our resource is offshore wind, so we really have to go after it. And so it is also the case that at the time, the UK was part of the EU, which meant that the European Trading Scheme, the ETS, was also part of the story, and that was starting to elevate costs for fossil fuel generation at the same time as renewables were dropping. None of that in the United States. We don't have the infrastructure. We don't have the policy. There was long-lived public opposition in the United States, which was not the case in the UK.
Right.
I could go on. But it should remind everyone that nothing in the energy transition is easy or inevitable.
So, moving to the other side of the world.
Wait, before you do,
Oh, yeah.
I would want to share with your audience this wonderful song by a progressive rock band called Quantum Pig. And it is a song about the end of coal in the United Kingdom. It was written about 3 or 4 years ago. It's a beautiful song. I strongly recommend your audience listens.
Yeah. Let's play a little bit of that now. Let me play it. Okay.
Between the old world and the new, between the facts and the truth, between the city and the state, between the flood and the flood.
So, wanted to talk about China and production of solar panels there. And sorry about that. We have a couple of dogs here today. With the decline in cost of solar has been a topic we've returned to again and again here. Seemed up till now to be an unstoppable, plummeting cost curve. The implication of this story from Goldman Sachs is that there's a wave of factory closures, as a result of many billions of dollars of losses that Chinese factories that produce PV have incurred. This then is projected to sort of balance out the market and maybe increase prices or I don't know, stabilize prices. I mean, what do we think this is just one more blip in sort of the stories about supply chains and the energy transition where it's really not that meaningful, or are we now going to see a correction in terms of the cost of solar?
Well, let's start by saying we have already seen recently, like the past 2 years, price increases in solar. And we've seen those because of supply chain challenges, because of capital cost increases, due to inflation. Like all of these things have contributed. Those have been largely seen as transient. This is a bit more structural. Here we had a case of oversupply, which was depressing costs. To be clear, that also ties into things like the WTO challenges against dumping of solar panels, because in fact, if you have a lot of oversupply and you are selling it below market prices and you're selling at a loss, that is exactly how the WTO defines dumping, right? So China does this on all kinds of things. They've done this with steel. They've done this with solar panels. They've done this with many different kinds of manufactured goods. In this case, they had oversupply. They are shuttering plants. They are choosing winners and losers, and there are some losers in that mix. That structural change will decrease the oversupply substantially, and that will lead to price rebound. Now, China could reopen these things or, other kinds of actions to get the supply back up. Let me also add that I think that there's a geopolitical component of this, that tariffs for solar imports in the United States and in Europe have in part soured Chinese manufacturers on the export market too. It makes it harder for them to make money. So you combine that with China's macroeconomic woes, it may be a while before we get that kind of supply back up. That's a problem for the climate. It may be good economics for the country, but it may even be good politics, but it's not going to deliver a whole bunch of solar at below market costs. Like, that means costs will go up for everything, including electricity generation.
Interesting. Flipping back, well, we're sort of doing a round the world segment today. Over in Africa, there's a story from the World Meteorological Organization, which reports that African nations are losing up to 5% of their GDP every year as they bear a heavier burden, I'm quoting here, than the rest of the world from climate change. Africa as a whole is responsible for about 10% of global greenhouse gas emissions, but it is the most vulnerable region to extreme weather events, and that is having a huge impact on GDP. So I think important to call that out, because in some ways we can often feel here in the U.S., where we are kind of mostly separated from the direct effects. I mean, we read about them. Many of us have also had direct effects. I mean, through storm, it's fires, et cetera. But 5% GDP, that's a huge number. And just imagine what that would be like here if we were to experience that. Be quite something.
Oh, yes, it would. So let's unpack this a little bit. In dealing with climate, you have three options: mitigation, adaptation, suffering. And the first stories we were talking about were about mitigation. Now we're talking about suffering. And in point of fact, the next story will tie back into that too. We are in the hottest summer of human history. Last year was the hottest year in human history. We're starting to see these things really land. It has always been the case, and it has been oft stated, that the countries that have contributed the least to climate change will suffer the most. Now we've got some numbers on that. And that's the difference about this story. It's not just something to say. 5% of GDP estimates is pretty shocking. And the World Meteorological Organization is not like some bucket of chumps or some environmental NGO. Like, this is real scientific teeth trying to understand this. And it should ring the alarm bell, in part because this is just a humanitarian tragedy. It is politically destabilizing. And it's coming for everybody. Like, the fact that it hit Africa biggest and first, perhaps, doesn't mean it won't be hitting other parts of the world. You're going to see these things in Latin America. You're going to see these things in OECD countries, in India. These impacts are going to be manifested as well and measured by economists, and will be devastating. One symptom of that, by the way, is being represented in our next story around insurance losses. For those of you who are not necessarily big on the insurance market, there's two kinds of insurance companies. There's insurers, and then there's reinsurers. Right. And reinsurers are the ones you're familiar with: Prudential and Swiss Re and these kinds of companies. Anyways, it matters because reinsurers bundle other insurance and take the risk at an arm's length, whereas insurers face the risk directly associated with loss. And the punchline of this story, read in Bloomberg, is that the reinsurers are doing okay, but the insurers are not. All of these consequences, all of these climate damages, all of these losses are really savaging the bottom lines of insurance companies. And it's making them grossly uneconomic. And that means there's going to be bankruptcies, there's going to be closures. That doesn't serve consumers at all. If your insurance company goes under, what does that mean for you? Oh my goodness.
Yeah, and we've talked about this with Spencer Glendon a few times, who is the head of risk for the investment firm Wellington for a while, and now his website is probablefutures.org, and he's very thoughtful about the insurance markets, and they really do underpin everything we do, everything we build. You can't really do anything without insurance. And the insurance market is underpinned by a set of assumptions that are based on historical averages. Once those assumptions no longer are true, as they're proving not to be by this, which we can see is evidenced by this story and plenty of others, those products can no longer be offered. And so that's a huge, huge risk to continuing to manage society and for society to continue to function as it has so productively for many decades. So with that, we'll wrap up today's episode of Climate News Weekly. Thanks so much, and we hope you can join us for our next conversation.